guys, welcome back to the Capital Mindset Show. Today we're going to be discussing two different stocks. The request was for one of these stocks, but I figured that they're both so similar that we're going to do both of them. And those are UPS and FedEx. So we're actually going to get started here with the price action on UPS. And we're only going to be talking about the presentation of UPS because more or less it's about pretty much the same. All right, so a quick disclaimer. I'm sorry if things look a little bit more zoomed out on a different resolution monitor. So taking a look at UPS on the max, we see it's not done too good, to be honest, over the longer term. So it's only done up about 173% since inception. So not too good. P ratio 26.61. If we just look at that, we're like, oh, it's overvalued. All right, so remember that's on a GAAP basis. All right, going over the PowerPoint presentation, basically what we're looking at here is a slight growth, right? And a little bit of their core values: customer first, innovation driven, people led. This is very important. So I'll talk about a little bit about this in a second. And we take a look at some of their growth rates. So changes 9%. Okay, we'll take a look at their real numbers in the model, but just quick overview. All right, so we are ready for peak, collaborating with our customers to match their needs and available capacity. Basically, because for those of you who've been paying attention, the United States economy has been struggling to get workers, a lot of inability to deliver products. So, for example, the chicken shortage. There's a lot of chickens, but there's not enough people to deliver the chicken. So then there's chicken shortages in the grocery stores, et cetera. And taking a look here, so they believe, strong macro environment. Okay, so how much of that growth is real growth? Remember that you have to take real GDP growth, not just nominal GDP growth. That's something to think about. United States probably averaged out over the course of the long term will probably be very low economic growth going forward. We can know that by long-term interest rates, what they kind of tell us. And then taking a look here, we see a little bit of some differences in the years. So 2020, a little bit drop plateau. And then we see volume mix. Okay, so volume was really high in 2020. That makes sense. So these things you think about, does it make sense? I'd say yes, it does make sense. But is this a one-time thing? Is UPS going to continue to have the same level of business that they did in 2020, right? So you see volumes are definitely down, right? Revenue has been going up though. Okay, so that's something to think about. Revenue is going up while volumes are going down. Probably margins are going up. Okay, margins are probably going up because they're probably charging more. Okay, so let's take a look at anything else crazy. There should be some stuff about warehouse automation. Well, we can kind of see this warehouse, not really in warehouse automation stuff, but both of these businesses are investing heavily in warehouse automation. Okay, this is a dividend. If you're a dividend investor, there you go. They pay a dividend. I'm not an absolutist, so I don't think dividend only or no dividend at all. I'm kind of like, it depends. It entirely depends on the business, the circumstance, etc. Okay, so I think that was pretty much covers the highlights. Let's move over to the UPS. This is what we're looking at as the cash flow statement. I want to highlight this real quick for you guys. So if we take a look down here, this is the cash flows from operations right here. This is the CapEx over here. So we see that these are heavy capital intensive businesses. And I want to highlight this line item right here. This is going to be very important. Changes in accounts payable, right? Changes in accounts payable. I'm going to highlight this, so we just follow it right here. So I want you to notice it's a positive number. And what this basically means is this is reconciled for the cash flow statement, where the in the cash flows from operations, it's a positive factor, meaning that they didn't actually pay that out in cash. Accounts payable means you owe money, right? So in the net income, right up here, this line item, it was recognized as an expense because remember, GAAP net income uses the accrual basis of accounting, which means, it takes into account the time factor when things are utilized, but then the cash flow statement takes into account only when cash leaves the bank account. Only when cash leaves your bank account, that's when it's counted in the cash flow statement. All right. So the cash did not leave the bank account. So we add it right back in, and then cash flows from operations look bigger, right? So management can they're not supposed to do this. It's illegal to manage earnings, but they can kind of swivel some things off. So, but this wasn't that case, by the way. I just want to say that. So they recognize that expense in the income statement, but it's not really an expense with cash, right? So that's the cash flows from operations, and then that's the CapEx. So CapEx intensive business. All right, taking a look at the key ratios. Let's take a look at this. So fantastic current ratio. So you want this to be above 1. What that means is they have enough current assets to cover current liabilities. We also have the solvency ratios. Everything's coming down. Fantastic. I like to see that. By the way, if you guys want to pause here and just take a look at what's happening, if it's getting better or worse, that's what this column's for. So you guys can just pause it and be like, all right, that's getting better, that's getting worse, that's getting better, that's getting worse. And it's a quick way to go through it. All right. You want to see just improvement. Business improvement is always great. And by the way, it's basically improving across the board. There's some profitability ratios that are out of whack because of 2020. So, and right there, you see the margins are compressing in 2020, but the revenue has gone up now. So margins have gone up. You see, more margins have gone up. See the story from the numbers, everyone. All right, taking a look here. Earnings quality, the way you want to read this is if it absolute value is above 1, fantastic. For those of you who don't remember this from math, the absolute value of a number is you take a -1 and that becomes +1, right? So if you saw a negative number, just make it positive. And then if it's above 1, good. That's how you read that. Everything around here, good. I don't really care about book value. All right, taking a look down here. So here, cash conversion cycle coming down. That's the one I'm going to highlight the most because this is basically the ability for this business to command the cash to come now. So cash is more valuable today than it will be tomorrow. So you want a business that is very powerful. We did discuss in a video a while ago when it was the food industry. And I think it was a video about Tattooed Chef and kind of showing you guys that company against the Goliaths of the industry. And PepsiCo, of all the businesses, had the lowest cash conversion cycle. So that's kind of indicative that PepsiCo has the most negotiating power at the table, right? So you want this to be coming down. And we do see that coming down. That's indicative that UPS as an organization has tremendous negotiating power in those who they deal with. All right, moving over to the summary report. Let's take a look quickly at the ability for them to not go bankrupt. And the Altman Z score is above 4, which is very good. So no. And is the company at risk of bankruptcy in the 3 years? The model is telling me no. Okay. So taking a look at the sales and cash flow figures, we see the trend line. The trend line should be extending in the final version of the model that will be published on the website. It should be extending farther out so you can kind of do visuals. But what you can kind of do here is imagine that the line continues. So we expect it to slow down or come back down to trend, right? And taking a look down here, cash flows, same story, maybe come down to trend, right? So taking a look at the average growth over the past years, it's about 9%. And ignore these for now, but taking a look at that, knowing what we know now, looking down there, will they grow at 9%? I don't know. Maybe, maybe not. All right. Taking a look at what they've done is they've actually diluted you by about 0.26%. That's barely anything. So I already put that in there. And they're debt heavy. Well, they're barely using any equity. So they're going to be using some debt, right? It doesn't mean that they have a lot of debt. It just means that they're using more debt than they are equity. Okay. So you guys already kind of see the discount rate I applied, 12%. So 20% margin of safety. And yeah, you have to assume a decent amount of growth, about 12%, between 11 and 12%. In order to make this make sense to you. Okay. And that's about a 210% rate of return over the next 10 years. So nothing like crazy. You're not 10xing your money at all, nothing like that. And things have to go precisely as planned, which is a 12% required rate of return. You must have these scenarios occur. Okay. And that's not including, dividends or anything like that, or buybacks. If they do any buybacks and shares reduction or shares dilution, that's only including the scenario. Okay. If we want a higher discount rate, we can already see we can't assume any of this. Now, if you really think that they're going to grow at 15 or 12%, we're not too far away from these prices, right? So patience is key in investing. You have to figure out the price you're willing to pay for it. And then you just wait. No one's putting a gun to your head. No one's telling you you must invest in it at this price. You just wait, right? Just be patient. And so taking a look at what happened here, for a long time, they were trading here. Okay. Long time. Everyone had an opportunity to do this. Okay. So at 98, 100, stuff like that, they were there, okay? And the expectations were lower, and one could have been buying then and there, and you could have assumed much lower growth rates, okay? So things can come down. It's just exuberance. We know they were very important in the market of 2020. So taking a look at FedEx, let's jump over to FedEx, and let's go to the I guess, yeah. Oh yeah. I wanted to go over the same line items right here. So change in accounts payable, I'll highlight across. Oh, look at that. It's a negative number. So basically what that means, some accounting lessons here, is you have the net income, right? And they reconciled it to the cash expenses. But what happened was instead is that it's a negative number. Remember, UPS was a positive number. So FedEx actually paid it out. So this is making their cash flows from operations a tad bit lower. You can see the difference. They actually came down, right? And this is separate from the already declining net income, but it's not even that much, right? This line item is bringing it down quite a bit, right? So they're actually paying cash out to their accounts payable. And look at this CapEx. Remember what UPS's was? Let's go back. So UPS still had high CapEx, but much lower than FedEx. FedEx is spending a lot more in CapEx. Now, this is drawing down the cash flows in the short term, but over the long term, it may or may not pay dividends. Now, I do know that both of them are investing heavily in warehouse automation, heavily. So what we're seeing is the smaller company is actually spending more on capital expenditure than UPS. Very interesting. Now, I don't know if that's good because it could be just spending willy-nilly, but they are spending more. So we got to actually, like, if someone knew a little bit more about what it is that they're spending on, that would be more pertinent information to then drive future projections on cash flows, right? Because if they're investing it prudently into good warehouse automation technology, which I do think they are, because I do know some of who's they're buying from. I can't say that, but I can't say who, but I know who they're buying from. And it is a very good company. Okay. It's not a publicly traded company, so it's not an information that would make you any wealthier. Just legally, I can't say who. But they are buying from a very good, reputable business. And I know their technology is very good. All right. And again, it's not publicly traded, so it's not information that I'm withholding and you're not going to make any money from it. No. But what I am saying from that information is that I know that the technology that they are buying is good. So whatever they're planning on doing with warehouse automation, it's going to be good in the future. Okay. So I don't know if all that money, that CapEx, is going into that. I don't know that. So, because I don't have insider information on publicly traded equities. Yeah. And buybacks, they are doing some buybacks. So let's assume some buybacks on 0.07%. So don't want to erase that. Okay. I have to retype it. Bloopers right there. All right. So we have basically, when we assume a no growth, we got to get it at 71. Let's take a look at FedEx. FedEx, by the way, over the longer term has been a much better investment. So they've grown about 3,000% since inception, but let's be fair. Let's get them at around 1999 and 419%, way better than UPS. All right. UPS has significantly underperformed this. But, that's neither here nor there. We care about the future, not the past, right? And they both pay a dividend. And look, on a PE ratio, it looks cheap, but on a cash flow basis, right, it's probably not like that. Let's go to the key ratios and actually find out. All right, so we'll go over piece by piece, but I want to go to the second part to find that out. So the current ratio, fantastic. Cash ratio, remember, that's the most conservative. Debt ratios, actually better. Yeah, they're better. And go looking at the gross profit margins. So gross profit margins for them did not come down during 2020. That was UPS. Okay, UPS, it came down, but for FedEx, it was actually up, and then it came a little further down in 2021. All right, so opposite story. Interesting. And then looking over here, we take a look at the earnings quality. Okay, very good across the board. They never dipped below 1. EPS and free cash flow per share. So they're trading at about what's the price at right now? Yeah, so about 20. Ugh. Yeah, 24. So I want to highlight that, right? 24 with a P of 13. 24, P of 13. Okay. So 24 price to free cash flow, 13 at PE. Very misleading. People go, oh, 13 PE, cheap, buy. No. Nuance. And then going back to UPS is 26. Cash flows. Well, let's actually do that because I don't want to treat them differently. Okay. So cash flows, let's go. So we have 9.4, and let's round that up to about 10. Like that's like a 20. They're trading about the same, right? They're trading about the same. They're not so far apart. Okay. So let's go down here to the cash conversion cycle. It's been about the same. That's so weird. So that might be a little bit of a mistake, but let's take it at its word. They're trading about the same. What we're basically saying, or deriving from that understanding, is that FedEx has less power than UPS. That's all. Okay. Because let's remember what UPS's was. Yeah. They have less power than UPS. Okay. Let's take a look here at the summary report and let's kind of conclude our thoughts. So I think that if FedEx, for example, has a higher growth rate going forward because they're investing a lot more in CapEx, that's what I basically assume there. That's an assumption. That's not a definitive statement. We can see that. All right. But what I want to close off with is for both of these businesses, they're trading expensively. They're not cheap. Okay. You are having to make a lot of assumptions in order to justify certain rates of return. Be patient. There's no reason for you to jump the gun and invest now. If you like these companies and you really like these companies, there's nothing stopping you from buying it. I'm not saying this is your decision, your research. But what I would do for me is I'd have them on a watch list and I just wait. I would wait. And then I'd wait for prices to come down materially. And I think they can, right? If things keep going with how I think they might go with regards to like the credit crunch or like these sentiment fears, you might actually see those prices again. And I don't think that they're going to markedly grow. So the fundamentals over the long term should be reflected in the share price. And I do think that the growth rates just aren't there. Of course, it could be just completely wrong. You know, that's just my opinion. But yeah, that's my opinion. All right. So on that note, I'm not going to be buying these businesses. I don't think they're bad businesses. Remember, separate the stock from the price, right? So the stock price from the business. Good business, just not for me at this moment. If you guys have any other requests, by the way, leave them down in the comment section below. I'm going to be doing a little bit more requests coming out today. And the date is 1/27/2022, just simply because I missed yesterday. And for those of you who have not seen, I'll highlight this in a couple videos just in case. The video that was copyrighted is now released. The information there is no longer up to date because it was supposed to come out early Monday morning. And obviously it came out or was allowed to be shown much later. And so just watch that for the meme if you want at the beginning of the video. And yeah, the rest of the information is kind of out of date. So I already covered that in the video that I did end up releasing Monday to cover for that video. On that note, guys, I hope you guys have a good one. If you guys like this video or you want to share it with someone who's actually looking into these two companies and you think it provides value, go ahead and do that. That helps the channel out a lot. If you guys smash the like button, you know, that also helps the channel out a lot. And if you guys aren't subscribed and you guys want to watch more informative, or I think maybe a little bit informative analysis on different companies, go ahead and subscribe and then just comment down below requests and I'll add it to the list. I'm trying my best to keep up with that list because that list is, to be honest, it's about, I think it's sitting at 64, 65 requests. So I'm going to be trying to knock that down. I promise to try to do one a day. And then I think more requests are going than one a day. So I'm going to have to probably do multiple a day. And I hope not to spam you guys too much with videos. But on that note, guys, I hope you guys have a good one. I'll see you on the next one.